Hello there with your markets news. I'm Diabo Seto. Chinese shares notched up marginal gains on Tuesday, whereas those in Hong Kong fell as the initial euphoria over a Sino-US trade truce involving the reduction and delay of tariffs gave way to caution. The U.S. will cut extra tariffs imposed in April on Chinese imports to 30% from 145%. And then the Chinese duties on the U.S. imports will fall to 10% from 125%. Japan's Nikkei added 1.4%, while Hong Kong's Hang Seng lost 1.9%, retreating from a 6-week high. Then China's Shanghai index firmed 0.2%. U.S. stock futures backed off on Tuesday as economic worries replaced U.S.-China truce euphoria. The spotlight will be on U.S. inflation data that's due out later today, which will reveal the impact of the tariffs. The shift in U.S.-China trade relations has led to traders to a Federal Reserve rate cut bets, expecting policymakers will be likely under less pressure to ease rates to boost growth. Traders are now pricing in about 56 basis points of cuts this year, down from over 100 basis points during the height of the tariff-induced anxiety in mid-April. The S&P 500 is currently up at 3.26%, while the Nasdaq is up at 2.81%, and the Dow Jones is up also 2.8%. And locally, the JSE is currently mixed at midday. The all-share index is up 0.2%. It's sitting at 92,394. A quick look at our currencies. The rand is currently trading at 18 rands 30 to the US dollar. It's at 20 rands 31 against the euro and at 24 rands 17 to the pound. And another look at our commodities for today. Gold is trading at $3,254 an ounce, while platinum is sitting at $991 an ounce. The price of Brent crude oil is currently sitting at $65.33 per barrel. Roy Mutoni from Sanlam Investments is our market commentator for today. Roy, thank you so much for joining us. We see that U.S. and Chinese markets are slowly recovering. We see that the truce is happening slowly, helping the markets to recover from the trade furor. What do you and Sanlam read into this?
Yeah, thanks for having me. So clearly, it's almost like all is forgiven, and markets have gone back to the rally that they had previously. But I think it's important to understand that this isn't the same as pre-Liberation Day. There are still tariffs, they're still considerable, and there's still going to be an impact on the economy. I guess the concern, or rather the worry, is that we were definitely going into a recession. Now it feels like we're not, or it's going to be a whole lot slower. So I think it's going to be one where we watch the hard data as it comes through over the coming weeks to see just how much supply chains have been disrupted, just how much some of this feeds into inflation, and also at the end of the 90-day reprieve, whether they actually come to a lasting, sustainable agreement that takes the uncertainty out of the markets.
Yeah. About the tariffs still, Roy, to what extent can we expect the print of the inflation, the U.S. inflation coming out later today, to also be reflective in those numbers later?
So that's a little bit of a complicated point, because for sure there will be some impact. But remember as well that a lot of companies stuffed their supply chains ahead of all of this because they expected some level of tariff. So it's actually spread out, and it's going to be muted in some areas. So I think you're not going to see so much today. You're probably going to see it in the coming in the next month and the month after that. But expectations in any case are for marginally higher CPI. Remember, last month CPI was down in the US.
Yeah.
Now expectations are for it to be marginally higher, which has implications for the interest rate outlook there.
Yeah. Let's come back locally, Roy. Locally, the unemployment rate, the local quarterly labor force survey by Stats SA was released a short while ago, and we saw that unemployment has gone up 1 percentage point. Would you say that things are really bad in the unemployment space, which most probably is, or are we seeing the base effect from the fourth quarter numbers? And how would you say the market is digesting this number?
Look, there's no way to be positive about a 32% unemployment rate. The labor force actually shrunk because more people became discouraged from looking for work. And like you said, there are more people who are unemployed there. So it is a difficult situation. It may be a reflection of the fact that we have incredibly high real interest rates. The market, this is a number that we know. We haven't seen significant turnaround in the private sector. We haven't seen any real initiatives underpinning employment. So this isn't something that's surprising to the market. I think when people look at the budget that's coming, they're expecting to see initiatives there that underpin employment and may start turning around this trend. But no, there's really nothing positive that comes out of a number this big.
Yeah, I'm glad that you touched on the budget 3.0 as it has been dubbed. What is on your notes at Sanlam Investments with that coming up next week? Do you expect a hectic change from the one that we saw and the second one as well?
Look, I think it's important that there's not a version 4. That's the first thing. The second thing is to acknowledge that the growth implied in the previous iterations is probably not going to be realized. Therefore, there has to be a compromise on the spending side of things. And when they cut back on spending, we just hope it isn't more on the infrastructure side, which, like I said previously, is probably what underpins employment and GDP growth a whole lot more. So it's a lot more pragmatism, more likely that the political principles come to an agreement, and for the framework to be employment friendly and allow us to move forward.
Yeah. Let's delve into a little bit of some company news before I let you go, Roy. Octotec, they released their results earlier today. They call themselves Real Estate Investment Trust, and they're also the owners of Kilani Mall, I understand. They saw their earnings go up about 1%. They're not quite so confident about what the GNU is doing and also the benefits of the interest rates, because now they're seeing what is happening with their tenants commercially and residentially. How do you see these results?
So I would say they're moderate. So from the residential perspective, they're full occupancy. Now they said there was a benefit from the 75 basis points of cuts last year, but office is still dragging significant vacancies there. Retail looking pretty good as well, almost full. But when you add it all up, I think there's still a little bit of restructuring. They're hoping that interest rates continue to come down, which will underpin its customers, underpin consumption, underpin footfall into its malls, which would allow for rental property growth, income growth over the medium term. So I'd say a moderate result, reflecting what we're seeing in the other real estate trusts from a macro perspective.
Yeah. On this GNU effect, Roy, would you say this is what all the real estates are seeing, that there's delayed benefits when it comes to the whole GNU makeup?
Well, the thing is, I think we all expected the GNU to underpin new growth. What we've seen is a little bit of confusion, a little bit of disagreement, and we haven't seen that take off. So that's when the election happened, that's where a lot of confidence had come from. Right now, there's more wait and see, and a lot of it will depend on what comes out of this budget. So yes, a little bit of uncertainty creeping in. Lots more questions being asked, but I think people are becoming more and more comfortable with the concept of a GNU, with the concept of political principles disagreeing, but coming up with an agreement that could carry the economy forward.
Roy, thank you so much. It's always a great pleasure speaking to you. I've been speaking to Roy Motoni. He is our market commentator for today from